$850 billion. That isn't just some figure in a government report. It's a loaded weapon aimed right at your savings. And as of today, China's finger is on the trigger. For years, they called it a conspiracy theory, a total bond market collapse. They said it couldn't happen. But right now, we're watching the impossible become inevitable. This is a geopolitical divorce between the world's two biggest superpowers, and it's going to change the price of everything you own. Take the 30-year mortgage. It's about to detach from reality and skyrocket. The Fed won't be able to stop it. If you thought 7% was painful, you're not ready for what happens when the planet's biggest lender decides to walk away. To see why this crushes your buying power, you have to look past the headlines. Most analysts fixate on one number: China's holdings of standard US treasuries, around $760 billion. But that's not the full picture. Add in debt from agencies like Fannie Mae and Freddie Mac, and the real number is $850 billion. That's the leverage Beijing has over the American economy. It's the nuclear option. For 2 decades, we had a deal, a symbiotic relationship. China sent us cheap goods, electronics, clothes, furniture. We paid them in IOUs called treasury bonds. Then they did something clever. They took those dollars and loaned them right back to us by buying our debt. This kept our interest rates artificially low and their currency cheap, fueling their exports. It was the greatest financial trade in history for the American shopper, effectively subsidizing our entire standard of living. But that trade is over. The trade war of 2026 broke the cycle, turning a partner into an adversary. When the US slapped 60% tariffs on Chinese goods, we basically said their dollars weren't welcome here anymore. So China did the logical thing. They stopped recycling those dollars into our debt. Instead, they started selling. The latest data confirms it. They're dumping US assets at the fastest pace since 2015. This isn't an accident or a random blip. It's a strategic move by a foreign government to realign its entire economy. They're selling US Treasuries paper promises and using the cash to buy physical gold. They've been buying gold for 28 months straight, a record streak. They're trading paper from a government they now see as hostile for a hard asset with no counterparty risk. They saw what happened to Russia's money in 2022, frozen overnight. They're making sure it can't happen to them. Here's where it gets dangerous for you. The problem isn't that China is buying gold. The problem is that nobody else is stepping up to buy the bonds China is selling. The US government runs on debt. We have a $2 trillion annual deficit, meaning we spend $2 trillion more than we collect in taxes every year. To keep the lights on, Washington has to sell billions in new bonds every single week. It's like paying off one credit card by opening another. China used to be the guaranteed buyer at these auctions. Now, not only are they gone, they're flooding the market with their old bonds. This creates a supply shock. Imagine every house in your neighborhood going up for sale on the same day with 0 buyers. Prices would crash. The bond market works the same way. More bonds for sale than people who want to buy them means bond prices collapse. And here's the rule to remember. In the bond market, price and yield are on a seesaw. When the bond price goes down, the interest rate yield goes up. That's why you're seeing rates spike. Inflation might be cooling on paper, but the market knows the truth. There's no marginal buyer left. The Fed is doing quantitative tightening, selling bonds. American banks are already stuffed with government debt and sitting on massive losses. Japan is busy defending its own currency and is selling treasuries too. That leaves you, the American investor, as the last buyer standing to fund the government spending. But to get you to buy a 10-year bond, the government has to bribe you with a much higher interest rate. This pushes yields higher across the entire economy, affecting every loan, credit card, and car payment. The most direct hit? Your house. The 30-year fixed mortgage rate tracks the 10-year treasury yield. If China's selling pushes that yield to 6%, mortgage rates mathematically head toward 9%. That math is inescapable. We're witnessing something terrifying, a complete decoupling. The mortgage rate is divorcing from the Federal Reserve. We're taught the Fed sits in a control room steering the economy. That's a lie. The Fed only controls short-term rates. The market controls long-term rates. The Fed could cut rates to 0 tomorrow, but if China dumps $50 billion in bonds that afternoon, your mortgage rate would go up, not down. This neutralizes the Fed. It breaks their ability to save the housing market. We're entering a new era economists call fiscal dominance. In plain English, the sheer size of our debt matters more than interest rate policy. Make no mistake, this is a war. but it's fought with math, not missiles. China knows the American middle class is addicted to housing wealth. They know real estate is our economy's engine. By forcing our rates to stay high, they can engineer a depression here without firing a shot. It's asymmetric warfare, using our own debt addiction against us. The timing is no accident. It aligns perfectly with the semiconductor sanctions. We cut off their access to advanced chips. They're cutting off our credit. The difference is stark. China can survive without high-end chips for a few years. The US economy cannot survive with 9% mortgage rates for even a few months. It would cause total collapse. Look at commercial real estate. Office towers are empty, teetering on bankruptcy because they can't refinance their loans. If foreign selling spikes rates again, that's the final nail. Trillions in real estate value could vanish. The US Treasury is trapped with two terrible choices. Option A, force the Fed to print trillions to buy the bonds China is selling. This would explode inflation, doubling your grocery bill. We destroy the dollar to bail out a foreign adversary. Option B, do nothing. We suffer a deflationary depression that makes 2008 look mild. This is the dilemma Beijing created. Heads they win, tails you lose. You're probably looking at your portfolio wondering, if cash is trash and real estate is crashing, where do I put my money? I'll share a specific defensive strategy shortly, but first, you need to understand the ghost in the machine. The data shows China is hiding its tracks using middlemen custodian banks in Belgium and Luxembourg to mask how much they're really selling. Officially, they hold $760 billion. The real number is likely much lower because they are dumping debt in secret. Every bond market rally is a chance for them to exit. This puts a concrete ceiling on bond prices and a hard floor under interest rates. The days of 3% mortgages are gone, likely for a generation. We're reverting to the historic norm. For 40 years, America had a VIP pass to cheap money. That pass has been revoked, and you're the one paying the premium in higher credit card rates, higher car loans. You're paying a geopolitical tax every month, whether you realize it or not. The American standard of living was built on cheap foreign money. That money is gone. We're watching 40 years of globalization unravel in 40 months. The bond vigilantes are back, but this time they're not investors. They're state actors selling to inflict pain. That pain is about to hit corporate America. Big companies borrowed free money in 2020. Those loans are coming due, and they have to refinance at rates 3 times higher. Imagine your mortgage payment tripling overnight. That's what's coming for them. It will lead to bankruptcies and mass layoffs. The stock market is ignoring this, betting the Fed will save the day. But the bond market knows the truth. The Fed is held hostage by the sheer volume of debt hitting the system. We're watching a slow-motion train wreck in the financial plumbing. There used to be a safety net called the reverse repo facility, a $2 trillion pool of cash that absorbed shocks. That pool is now empty, drained. There are no shock absorbers left. If we hit a bump now, the axle snaps. We could see a flash crash in treasuries where yields spike massively in a single day. That would break the leverage in the derivatives market, triggering margin calls globally. The entire system is fragile, leveraged to the hilt, and now under attack from its second largest player. This is why smart money billionaires, family offices, is running. They see the bond market cracking and are moving into assets that can't be printed or devalued by a computer in Washington. Gold, land, commodities. These are the only safe harbors left. For 40 years, the 60-40 portfolio, 60% stocks, 40% bonds, was gospel. That strategy is dead. Bonds were your shield. When stocks fell, bonds rose. Now bonds are the sword, the source of the risk, the epicenter of the quake. Holding a long-term U.S. government bond used to be risk-free. Now it's a gamble on world peace. And if you look at headlines from Taiwan or the South China Sea, peace isn't the trend. The $850 billion sell-off isn't a future threat. It's happening now. The dollar is being strangled by the very nations that helped build it. But before I get into the 3 assets you need to survive this, you have to understand the plumbing. Usually, financial plumbing is boring until the toilet backs up and floods your house. Right now, a critical valve has run dry, the reverse repo facility. Think of it as a giant emergency water tank. For 2 years, it held over $2 trillion in extra cash, a shock absorber that let the Treasury sell trillions in new debt without breaking the market. As of this month, that tank is empty. Now, every dollar the government borrows has to come directly from the banking system, from your bank's reserves. The timing is a perfect storm. We're hitting a liquidity cliff just as China dumps $850 billion in bonds. Imagine driving up a hill, running out of gas, and having your tires slashed at the same moment. That's the US economy. Without that buffer, banks are scrambling for cash. This puts immense pressure on regional banks. Remember, Silicon Valley Bank in 2023? That was just the trailer. Now we're watching the main feature. Here's how it works. Banks take your deposits and buy safe bonds. When rates rise, the value of those old bonds falls. The FDIC says American banks are sitting on over $600 billion in unrealized losses. They rely on a loophole. As long as they don't sell, they don't have to admit the loss. But if you get scared and pull your money out, the bank has to sell those bonds at a 40% loss to pay you. That's what busted SVB. Now that risk is everywhere. China knows this. By selling bonds and forcing rates higher, they're making the hole in bank balance sheets bigger. It's a deliberate strategy to attack the capital base of the American banking system, our Achilles heel. If banks are broke, they can't lend. If they can't lend, the economy stops. In 2023, the Fed launched the Bank Term Funding Program to save the banks. That program has expired. Now the Fed has a binary choice. Let banks fail, ATMs stop working, or print trillions to cover the losses, destroying the dollar through inflation. Both options end in pain for the average American. The attack isn't just in the bond market, it's in the energy market too. For 50 years, we had the Petrodollar system. If you wanted oil, you had to use US dollars. That created permanent global demand for our currency. That era is ending. China, the world's biggest oil customer, is now paying for oil in yuan, using swap lines with Saudi Arabia, bypassing the US financial system entirely. The middleman they're cutting out is us. This reduces global demand for dollars just when we need buyers the most. For the first time in decades, Saudi Arabia is openly accepting other currencies. It's a direct attack on our exorbitant privilege, the magic credit card that let America run up massive debt because everyone needed dollars for oil. That credit card just got declined. If the world needs fewer dollars to buy oil, they have less reason to hold US Treasury bonds. This shift aligns perfectly with China's bond dumping. It's a pincer movement, attacking the dollar from the supply side, dumping bonds, and the demand side, buying oil in yuan, squeezing it from both ends. The impact is already here. Investors are demanding higher payments to hold US debt because they see the scary truth. The US government has no real plan. Well, it has a bad one. Borrow new money to pay the interest on the old money. In the criminal world, that's a Ponzi scheme. In Washington, it's fiscal policy. A Ponzi scheme works only as long, yes, as new money keeps coming in. When your biggest investor walks away, it unravels. We're already seeing cracks failed treasury auctions where nobody shows up to buy. The big banks, primary dealers, are forced to buy the unwanted bonds, choking on debt, clogging their balance sheets, creating a liquidity trap. In this environment, a sudden shock like a war in Taiwan could cause the entire bond market to seize up instantly. And here's the terrifying part. US treasuries are the collateral for the entire global financial system. If the treasury market freezes, the whole system freezes ATMs, credit cards, everything. The Fed is terrified of this. They're talking about slowing their own bond sales, but that's a band-aid on a gunshot wound. The real problem is simple. The US government spends too much money. We relied on our enemies to lend us the cash to do it. Now they've stopped lending. So the spending has to be paid for by inflation, a stealth tax nobody voted for. You pay it at the gas pump, the grocery store, and when your car insurance doubles. The price of everything must rise to bail out the government. China is smart. They're forcing the US to choose between two disasters, hyperinflation or a Great Depression. They're betting American politicians are weak and will choose inflation to avoid pain today, even if it destroys the country tomorrow. History suggests that's a safe bet. So here's what will happen. The Fed will eventually panic, pivot, and turn the money printers back on. They'll give it a fancy name like market functioning support or yield curve control. Don't be fooled. It's just money printing. It will temporarily save the banks but destroy the currency. We're looking at a future where the dollar loses value faster and faster. That's why the stock market is going up, but not because companies are doing better. It's the Venezuela dynamic. In Venezuela, the stock market went up millions of percent because the money became worthless. If a loaf of bread costs $1 million, The bakery's stock price looks amazing, but you're still starving. That's what's happening to the S&P 500. It's rising in nominal terms because the dollar is collapsing against real assets. The safe asset of the last 40 years. The US Treasury bond is now the danger zone. The 60-40 portfolio is broken. Stocks and bonds are falling together. China has exposed the glass jaw of the Western financial system, showing the world the risk-free rate is actually full of risk. Now other nations are copying them. The BRICS nations, Brazil, Russia, India, China, South Africa, are building their own club and a new payment system to bypass the dollar. They're hoarding gold at a record pace, preparing for a new world order where trade is settled in hard assets, not paper printed from thin air. The US is becoming isolated. Your standard of living was artificially inflated because the dollar was king. As the king loses his crown, imports get expensive, and your purchasing power evaporates. But there is a way out. 3 specific assets historically survive currency collapses. I'll break them down. But first, look at the doom loop in housing. Go to the store. Look at electronics and clothes. The China price is dead. Cheap Chinese labor kept your cost of living low for 20 years. That era is over, replaced by the war price. Companies are panic moving factories from China to Vietnam and Mexico, friends whoring. It sounds nice, but is expensive. We're moving from just-in-time efficiency to just-in-case safety. Safety costs money, and you're paying the bill. This is dangerous because the US economy is 70% consumer spending. People spend because they feel rich. Their house and stock portfolio went up. The wealth effect. Here's the nightmare. If China crashes the bond market, mortgage rates hit 9%. That crashes housing. The wealth effect vanishes. People stop spending. The economy freezes. This triggers a doom loop. A bond crash leads to a real estate crash, which causes a recession. A recession means lower tax revenue, a bigger deficit, and more bond sales to pay for it, which crashes bond prices further. It's a death spiral, and China is feeding it. Every bond they sell accelerates the crash. It's a calculated medieval siege, cutting off the supply of cheap money to the fortress. Inside the fortress, the commanders are gaslighting you. They say the economy is strong, but the foundation is rotting. Look at jobs reports. A great headline number released, then revised down months later when nobody's looking. Look at GDP growth. It's fake, driven by government credit card spending, not real production. We're borrowing money to buy growth, but the math is broken. For every dollar of new debt, we get less than $1 of growth back. We're spending $1 to get 50 cents. It's a losing trade. Now that interest rates have tripled, the credit card bill is due. The interest payment on the national debt is growing exponentially and will soon consume the entire federal budget. That means no money for roads, bridges, or schools. Every tax dollar you pay will go to the Social Security or interest on the debt. This is the straitjacket China has put us in, and there's no wiggle room. If a recession hits now, the government can't afford a stimulus check without destroying the dollar completely. We're flying without a parachute. The bond market is the hard, unforgiving ground rushing up to meet us. The bond vigilantes are back, and they want their pound of flesh from your retirement account. The great wealth transfer isn't a conspiracy. It's simple mechanics. When a government can't pay its bills with taxes, it pays with inflation. Inflation is a tax on your savings that you never voted for. You work hard for dollars, save dollars, but the government prints dollars for free, diluting the value of your labor and stealing your time. China understands this perfectly. That's why they're leaving the casino, refusing to hold a currency destined to die. They're not alone. The smartest money in the world is running for the exit. We're witnessing a bank run on the US dollar at the highest level. Central banks are buying more gold than they have in 50 years, not because they like shiny rocks, but because it's the only neutral asset left. In a world of financial warfare, gold is the only money that can't be frozen by sanctions. The only asset that doesn't rely on another government's promise. The People's Bank of China is leading the charge, converting its trade surplus into physical bullion. But they're not just buying gold, they're buying something else, something much more practical for a future war economy. If you want to survive the next 5 years, you need to own it too. They're preparing for a post-dollar world where you pay with things that have actual value. This is basic economics Gresham's law. Bad money drives out good. The US dollar printed to infinity is the bad money. Gold is the good money. Nations that make real things, cars, microchips, are hoarding it. Ignore what bankers say, watch what they do. In press conferences, they call gold a barbarous relic and tell you to trust paper money. Then they go back to their vaults and stack gold bars faster than ever. They're lying. They're front-running the collapse. The 60/40 portfolio is a zombie. For 40 years, bonds were your safety net. In an inflation crisis, that net disappears. Stocks and bonds crash together. We saw a preview in 2022. We're about to see the full movie. Holding a US Treasury bond today isn't a risk-free return. It's return-free risk. You get paid 5% interest while inflation eats 7% of your purchasing power, a guaranteed loss. You're paying them to lose your money. So where does the smart money go when the dollar burns? To hard assets, things that can't be printed or ruined by a politician's signature. Productive farmland, energy infrastructure, copper, lithium, gold. These have real value because we need them to live. China is on a global shopping spree for these exact things. Copper mines in Africa, farmland in South America trading dying dollars for real dirt and metal before the music stops. Look at your net worth. Be honest. How much of it is real? If it's all in a bank account or 401k, you're vulnerable, naked, holding the bag for the government's debt. The everything bubble was built on cheap credit. The everything bust will be caused by expensive credit. It's gravity. If interest rates stay at 6%, stock prices have to fall. The math doesn't work otherwise. You can't have record high stock prices when money is this expensive. A painful reversion to the mean is coming for anyone who's passive. This is why billionaires like Zuckerberg and Bezos are selling tech stocks and buying land and gold. They're moving down the risk pyramid, closer to the base of reality. They know speculative assets get wiped out in this environment. You need to become your own central bank, holding reserves outside the system. Here's the most important rule for the next 10 years. If you can't touch it, you don't own it. If you own a gold ETF, you own a piece of paper, a promise from a bank. If the system crashes, that bank can pay you out in the worthless cash. Force majeure, it's legal and they'll do it. China understands this. They take physical delivery. They don't leave their gold in London or New York. They bring it home, draining the vaults and creating a squeeze. Soon, we'll see a price split. The paper price on TV and the much higher real price you pay to get a coin in your hand. We're already seeing this with silver premiums. The market is screaming that the paper price is a lie. The same danger applies to housing. Real estate is a hard asset, but it's wrapped in a debt bomb. If you own your home free and clear, it's a great inflation hedge. But if you have a big mortgage, that house is a liability, a trap. Even with a fixed rate, your insurance and property taxes are exploding, acting like a variable rate mortgage you can't control. It will get worse. Local governments are broke from the commercial real estate crash. Empty offices don't pay taxes, so cities will raise your property taxes aggressively to fill budget holes. Your home is becoming a tax farm for the government. You have to be smarter and more agile. You need liquidity. But in a crisis, liquidity doesn't mean cash. Cash is trash. It means owning assets anyone, anywhere will accept. Gold is the only asset liquid in every country, every currency, every crisis. It's the universal language of value. Needs no translation, no electricity. It works in a blackout, in a war. That's why China is buying it as an insurance policy, a great wall of gold for their economy. You need to build a wall around your family. Don't wait for the Fed to signal you. They'll never tell you to panic. By the time they admit there's a crisis, it will be too late. The gates will be closed. They'll try to lock you into the system. This is where central bank digital currency, CBDC, comes in the ultimate trap. It lets them track every penny, stop you from buying gold, and impose negative interest rates, taking money from your account just for saving it. This is the end game of financial repression. They need you to stay in the dollar so they can inflate away their debt. If you exit, you defeat their strategy, so they'll try to stop you. But right now, the door is still open. You can still convert digital numbers into real, tangible assets. No penalties, no restrictions. Yet, this window won't stay open forever. The $850 billion sell order from China is the first domino. It will knock over the bond market, then the stock market, then the currency itself. We're watching the death of the old system. The transition will be chaotic and volatile. But wealth is never destroyed. It's only transferred from the unprepared to the prepared, from the oblivious creditor to the smart owner. You have a choice. Will you be the creditor paid in the worthless paper, or the owner who holds what the world actually needs? China has made its bet against the dollar on the laws of mathematics. I suggest you look at the math yourself. Do you really want to be on the other side of that bet? The storm isn't coming. It's here, overhead. The roof is leaking. Build your ark. Load it with hard assets. But knowing what to buy is only half the battle. You need to know when the final collapse will trigger. There's one specific red line indicator that predicts exactly when the Fed will be forced to print again. It has predicted every crash since 2008, and it just flashed red this morning.